Okay.
Right, we just heard, I think there was a little bit of Twitter speculation that there's been a 5-month can kick on the Greece situation, which seems to have perked up the markets a bit, as you might expect.
I mean, inevitably, each time we've talked about this week, everything's been completely driven by Greece. There's been very few fundamentals driving the market. It's all about the sentiment of what happened in the last 30 minutes. Everything has been on a 30-minute timeline of everything that's going on with Greece, and I think ultimately it was the most likely outcome that they were going to kick everything further down the road, and that seems to have been what's happened.
So, I mean, even this is not confirmed. It's not it's confirmed yet, but even it's still the most likely scenario, really. Just a
yeah, I think they're going to keep them going at least to the end of this year. I know I saw the William Hill odds. There was a 72 chance of a Greek exit this year, and 1 to 6 of them staying in, and I think that's probably pretty good odds. They're going to keep going for the rest of this year.
All right, well, let's see what data we've had over the European session.
Yeah, we had slightly weaker German import prices. And I think that's because it's the first drop in 4 months, and that was driven by euro weakness, and they've managed to import a bit of inflation. But the interesting ones are these French numbers and the Italian numbers. French consumer confidence kind of held at 94, so there's a bit of weakness there. But the Italian ones have remained robust. The Italian consumer confidence, the Italian business confidence, and these Italian numbers keep creeping under the radar. Everybody keeps talking about the mess in Europe, but there are some strong numbers in there. Like the French consumer confidence is weak. The manufacturing numbers have been slightly more robust, and you see the same thing here in Italy. We've seen the consumer confidence index rose to 109.5 from 106 in the last month. 109 is a long way into growth territory. And we look at inflation expectations have decreased, and it's just you've seen that kind of strength there, and a lot of the business confidence we're seeing is linked to this Eurozone M3 money supply data that came through. We're starting to see, we're seeing that strong growth in loans to businesses, loans to households, and that was that number that just was completely frozen, completely crunched all the way through last year. No matter what measures the ECB pumped out there, no matter how cheap money works, no matter what kind of measures they put in place to try and get those banks lending to individuals, banks just didn't want to lend because there's so much kind of risk out there that they wouldn't lend it at any price. But now, arguably because of these QE measures that have been put in place, banks are finally sticking that cash out there.
Yeah, all this means is that the QE, which could have been done 5 years ago, should have been done 5 years ago. I mean, it is. I mean, all that suffering has been for nothing.
Yeah, I mean, I generally.
Is that fair?
Well, the problem is that we haven't really seen any supply side reforms happen. We've not seen any structural reforms. And my argument generally is when it comes to these things, when people are saying banks aren't lending, there's usually a reason why banks aren't lending. Banks want to make money. If it's a good business to invest in, businesses will invest. In London at the moment, people are dying to invest cash. If you've got a good business, you can borrow money. It's a great time to borrow money right now. But throughout last year, part of the reason why banks weren't lending is because it's not a great business environment. You look at France, you look at Spain. Those aren't great places to do business right now. And I think they just got to the point where cash is so cheap that they are lending out. We haven't really seen those reforms just yet.
Okay. Well,